What wound did ever heal but by degrees? Investors who bother to open their third quarter statements will be absorbing some losses. Can they be recouped over time? Also, job losses. They continue to depress sentiment in the United States. Will government action provide incremental progress? Helping me to analyze these challenges, we have Michael Feroli. He is the chief U.S. economist at JPMorgan. Also with us, Bob Pozen, chairman emeritus at MFS Investment Management, also a senior lecturer at Harvard Business School and a senior fellow at the Brookings Institution. And we have Michael Woolfolk, managing director and senior currency strategist at Bank of New York Mellon. Gentlemen, good to have you with us. Michael Feroli, let me start with you. Taking a look at the ADP report, which is the private payroll jobs report, plus you add in some of the ISM, that's the services data that came out today, the U.S. economy is not terrible, but it's not great. Is that accurate?
Right. And not only those data points, I think everything we've really seen, most of what we've seen over the past week has surprised to the upside. So we don't know if we're going to slip into recession the next year, but certainly we're not in recession right now. So I think through September we can say so far so good.
Bob Pozen, so far so good. So why does there seem to be a feeling that we're going into a recession? Or indeed, if you take a look at the stock market, you get whipsawed by these huge swings every day. You could forgive investors who say, I can't take it anymore.
Well, I think the swings are just because we have so much uncertainty. One day it looks like Europe is going to solve the problem, the next day it's not. But I think the key to stocks is what people's perception is of corporate earnings, and that relates to how much they're going to invest, how much we're going to get on the job front. We all know that there's a huge amount of cash on the balance sheets of U.S. companies. The question is, are they going to put it out there for new plant, new facilities? And I think that is primarily a question of stability. Right now, a lot of businessmen that I talk to say, look, we don't know what's going to happen next month, not to mention next year. That's not a good environment for stability. So this is where Washington could really help. They could have a resolution that's not just for 2 weeks or 2 months, but actually for 2 or 3 years, and that would provide some degree of stability going forward.
Michael Woolfolk, Bob Pozen mentions the word stability. Are you seeing a shift in investor sentiment when it comes to where they are finding stability? Are there currencies, are there asset classes where people are saying, yeah, that's a safe haven?
Well, it's interesting you mentioned that, Pimm. We started out with 4 primary destinations for safe havens. You had the dollar, the yen, Swiss franc, and gold. Over the last month or so, 2 of those are now gone. The Swiss National Bank has put a floor underneath Euro Swiss at 120. The market's talking over the last 48 hours about perhaps the likelihood of the Swiss National Bank raising that to 125. It has completely taken the Swiss franc off the table in terms of a safe haven destination. COMEX, other markets are raising the margin requirements on gold, on silver, on copper, and others. Again, punishing speculators for going long gold and other commodities. So this has funneled the safe haven capital flight increasingly into the U.S. dollar. Less so yen. It appears that yen is a safe haven, but only on behalf of Japanese investors who are repatriating from Australia, New Zealand, and otherwise. But there has been a shift in terms of increased risk aversion, and that has benefited the dollar despite relatively shaky fundamentals right now.
Michael Feroli, does this sort of highlight the tension that investors are having to deal with? On the one hand, they listen to Federal Reserve Chairman Ben Bernanke talk about a faltering recovery. They take a look at long-term interest rates. Those are declining. And then they get whipsawed by stock market action. Is there any doubt that they would stay on the sidelines until, as Bob says, we get some kind of stability?
Right. And not only, I think, instability in terms of markets, but in the next 2 months, we're going to have to hear from this budget super committee. I think there's a lot of uncertainty surrounding the outcome of that. So a lot of the fears that drove the markets in August regarding political uncertainties, I think, aren't behind us by any stretch of the imagination.
Bob Pozen, how much patience do investors that you talk to, how much patience do they have left with super committees, with Washington, with policymakers?
I think the level of frustration, and we should really use a much stronger word, disgust with what's happening in Washington is pretty strong. And, you know, we just had a mini crisis, and what did they do? Extend it to the mid-November, so then we'll have the super committee. I think it's really important that the super committee not just find $1.2 trillion. You know, they can probably do that by playing what are are called baseline games, like we were going to spend $8 trillion in Afghanistan, now we'll only spend $7 trillion, so we saved, quote unquote, $1 trillion. They have a big chance with Social Security. We know how to fix it. It's got a present value, the deficit of $5 trillion. We know the tools. You can do something on the benefit side, do something with retirement age, maybe do something a little with payroll tax. You can put a combination together and actually do something for long-term spending. And the good news is it doesn't touch anything for the next 2 or 3 years because you would have it phased in gradually. That's the sort of combination of short-term stimulus plus long-term discipline that the market's looking for over a longer period than 2 weeks or 2 months.
I hear a ticking clock somewhere in the background. We're going to continue the conversation. Coming up, dilatory time. How much time can investors afford to wait until they reap some profits? We've got more with our panel. This is Taking Stock on Bloomberg. All right, one may smile and be a villain. Now, to millions of investors, smiley market experts are no solace to lost money. We're speaking with Michael Woolfolk, Bank of New York Mellon, Michael Feroli, he's JPMorgan Chase economist, and Bob Pozen, Chairman Emeritus, MFS Investment Management. Bob Pozen, this idea that, politicians, money managers, they can smile all they want, but, when you open that third quarter statement, you're going to be a villain to your customers. Is there a possibility that, at least let's start with the people in Washington, that they understand the almost desperate straits that many investors face with low yields and lack of confidence in policymakers?
I guess they understand it theoretically, but it seems to be more important to both parties, a vindication of their ideological positions. And I think what we need is moderates, pragmatists on both sides of the aisle. Now, compromise is a bad word. It's not a bad word. That's how you get things done in Washington. And if Republicans say we can't have any tax changes in the tax code, even if there's some screwed up provisions that we all know should be changed, and if Democrats saying you can't touch Medicare, Social Security, we can't have a deal, and we need a deal. We need a compromise that works for everybody. It's there. People have mapped it out, but whether or not they can reach the conclusion, I think it's 50-50.
50-50. Oh, I don't know if I want those odds. Michael Woolfolk, Federal Reserve Chairman Ben Bernanke, he was speaking today, earlier this week before Congress, and he talked about a potential for a faltering recovery in the United States.
Yes.
And when asked what the Fed's response would be, it was very vague about what the Federal Reserve would or would not do. Are we relying too much on central bankers around the world to fix their economic ills?
Well, that's certainly the view of many central bankers.
What's your view? I mean, when you talk to clients, what do you tell them?
Well, look, certainly the U.S. and Europe share some similar troubles in terms of high indebtedness, in terms of low growth, and perhaps some inflationary pressures down the road. So central banks perhaps have a diminishing marginal return to further easing at this stage. The extraordinary measures that Trichet and the ECB have issued, maybe that can continue. Perhaps we can issue further extraordinary measures.
Do you think that the European Central Bank is going to lower interest rates before the end of the year?
I think that there's a better than even chance. I think that before then, they're going to engage in further extraordinary measures. They need to maintain liquidity during a very troubled time as they get through the Greek debt crisis. I think that's probably coming to a head here within the next month or two. But in terms of stimulus, we do need stimulus. There is still quite a bit in the pipeline. But further stimulus is likely needed here and in Europe. And I think to do that, we have to rely increasingly upon fiscal stimulus. That's difficult when you're trying to narrow the budget.
Well, I like your odds. Those are a little better than 50-50. Bob Pozen's only giving me 50-50 when it comes to policymakers in Washington. Michael Feroli, tell me about the odds of the U.S. right now going into a recession if Europe goes into a recession.
So first of all, I think Europe is going into a recession.
You do?
A mild recession. I think the U.S. can avoid a recession, but I would probably place the odds at a little less than 50-50 that we do get more stimulus in the next year. Certainly the president has called for that, and I think you're right to say really we're relying on fiscal now. But the resistance still seems pretty strong. So, and then if we turn to the Fed, Well, I think the Bank of Japan has taught us over the past 15 years that when a central bank is at the zero lower bound, there's not much more they really can do. So I think perhaps we are turning too much our hopeful eyes to the Fed and hoping they can bail us out or get us out of this economic situation. But when you reach that zero lower bound, everything is kind of just playing with the edges, I think.
Bob Pozen, talk about corporate profits and stocks, because you mentioned the connection before. But even if profits go up for companies, you still need somebody with money to go out and buy a share of stock for that share of stock to increase in value.
Yeah, I think that's true, but there's sometimes a lag. But in the end, if you get really good corporate profits, stock prices will go up. And one advantage of having zero interest rates, now not only on the short term, but on the 10-year, what's the 10-year down to 1.7%, is there not a lot of good places to have your money. So actually, there are a lot of stocks that have a dividend yield of 2 or 3%, and I think over time, people will think it's a lot better to be in good companies with 2 or 3% dividend yields than to be getting 0.5% or 0.25% on their money at the treasury or the bank. And I think that is part of what Bernanke's doing. He's now not only lowering the short part of the curve, he's lowered the long part of the curve. So you got a Hobson's choice. You can either take no yield and sit there, or you can take a little risk in the stock market. And if you stay with dividend-paying stocks, and I believe that that's where investors are going to go, I think you're getting a reasonable yield, and hopefully over time, maybe not right away, if earnings are strong, you'll get some rise in the stock market.
Michael Woolfolk, last point to you. Then what are you telling investors who say, all right, maybe I have a little bit in stocks, maybe those dividend payers that Bob Pozen says, but I want to be safe. Where do you go? U.S. dollar?
Well, I think it has to be the U.S. dollar for the time being. I think as a strategist, though, you want to look forward another 6 to 12 months, and you want to look and say, did we miss the biggest opportunity here amidst all this uncertainty? And it seems that with the Fed running out of opportunities to push the long-dated yields lower, that perhaps we've seen a bottom in the bond market last decade. Perhaps bonds are a sell. That money's going to go into the equity market. I think they're undervalued.
We've got to leave it there, gentlemen. I want to thank you all very much. Thanks for your insights.